8 Best Short-Term Investments in May 2022. If you're looking to invest money for the short term, you're probably searching for a safe place to stash cash before you need to access it in the not-so-distant future. The volatile markets and slumping economy led many investors to hold cash as the coronavirus crisis dragged on, and things remain uncertain as the economy now faces surging inflation. Short-term investments minimize risk, but at the cost of potentially higher returns available in the best long-term investments. As a result, you'll ensure that you have cash when you need it, instead of squandering the money on a potentially risky investment. So the most important thing investors should be looking for in a short-term investment is safety. What is a short-term investment? If you're making a short-term investment, you're often doing so because you need to have the money at a certain time. If you're saving for a down payment on a house or a wedding, for example, the money must be at the ready. Short-term investments are those you make for less than 3 years. If you have a longer time horizon, at least 3 to 5 years, and even longer is better, you can look at investments such as stocks. Stocks offer the potential for much higher returns. The stock market has historically risen an average of 10% annually over long periods, but it has proven to be quite volatile. So the longer time horizon gives you the ability to ride out the ups and downs of the stock market. Here are a few of the best short-term investments to consider that still offer you some return. Number 1. High-yield savings accounts. A high-yield savings account at a bank or credit union is a good alternative to holding cash in a checking account, which typically pays very little interest on your deposit. The bank will pay interest in a savings account on a regular basis. Savers would do well to comparison shop high-yield savings accounts, because it's easy to find which banks offer the highest interest rates and they are easy to set up. Number 2. Short-term corporate bond funds. Corporate bonds are bonds issued by major corporations to fund their investments. They are typically considered safe and pay interest at regular intervals, perhaps quarterly or twice a year. Bond funds are collections of these corporate bonds from many different companies, usually across many industries and company sizes. This diversification means that a poorly performing bond won't hurt the overall return very much. The bond fund will pay interest on a regular basis, typically monthly. Number 3. Money market accounts. Money market accounts are another kind of bank deposit, and they usually pay a higher interest rate than regular savings accounts, though they typically require a higher minimum investment, too. Be sure to find a money market account that is FDIC insured so that your account will be protected from losing money, with coverage up to $250,000 per depositor, per bank. Like a savings account, the major risk for money market accounts occurs over time, because their low interest rates usually make it difficult for investors to keep up with inflation. In the short term, however, that's not a significant concern. Number 4. Cash management accounts. A cash management account allows you to put money in a variety of short-term investments, and it acts much like an omnibus account. You can often invest, write checks off the account, transfer money and do other typical bank-like activities. Cash management accounts are typically offered by robo-advisors and online stockbrokers. So the cash management account gives you a lot of flexibility. Cash management accounts are often invested in safe low-yield money market funds, so there's not a lot of risk. In the case of some robo-advisor accounts, these institutions deposit your money into FDIC-protected partner banks, so you might want to make sure that you don't exceed FDIC deposit coverage if you already do business with one of the partner banks. Number 5. Short-term U.S. government bond funds. Government bonds are like corporate bonds except that they're issued by the U.S. federal government and its agencies. Government bond funds purchase investments such as T-bills, T-bonds, T-notes and mortgage-backed securities from federal agencies such as the Government National Mortgage Association, Ginnie Mae. These bonds are considered low risk. While bonds issued by the federal government and its agencies are not backed by the FDIC, the bonds are the government's promises to repay money. Because they're backed by the full faith and credit of the United States, these bonds are considered very safe. In addition, a fund of short-term bonds means an investor takes on a low amount of interest rate risk. So rising or falling rates won't affect the price of the fund's bonds very much. Number 6. No penalty certificates of deposit. A no penalty certificate of deposit, or CD, lets you dodge the typical fee that a bank charges if you cancel your CD before it matures. You can find CDs at your bank, and they'll generally offer a higher return than you could find in other bank products such as savings accounts and money market accounts. CDs are time deposits, meaning when you open one, you're agreeing to hold the money in the account for a specified period of time, ranging from periods of weeks up to many years, depending on the maturity you want. In exchange for the security of having this money in its vault, the bank will pay you a higher interest rate. The bank pays interest on the CD regularly, and at the end of the CD's term, the bank will return your principal plus the earned interest. A no-penalty CD may also be attractive in a period of rising interest rates, since you can withdraw your money without paying a fee and then deposit it elsewhere for a higher return. CDs are insured by the FDIC, so you won't lose any money on them. The risks are limited for a short-term CD, but one risk is that you may miss out on a better rate elsewhere while your money is tied up in the CD. If the interest rate is too low, you may also end up losing purchasing power to inflation. Number 7. Treasuries. Treasuries come in 3 varieties: T-bills, T-bonds and T-notes, and they offer the ultimate in safe yield, backed by the AAA credit rating of the US federal government. So rather than buying a government bond fund, you might opt to buy specific securities, depending on your needs. As with a bond fund, individual bonds are not backed by the FDIC, but are backed by the government's promise to repay the money, so they're considered very safe. Number 8. Money market mutual funds. Don't confuse a money market mutual fund with a money market account. While they're named similarly, they have different risks, though both are good short-term investments. A money market mutual fund invests in short-term securities, including treasuries, municipal and corporate debt, as well as bank debt securities. And since it's a mutual fund, you'll pay an expense ratio to the fund company from the assets being managed. While its investments are generally safe, money market funds are not as safe as money market accounts, which are FDIC backed. In contrast, money market funds can lose money, typically only in periods of severe market distress, but they are generally quite safe. Still, they are some of the most conservative investments available and should protect your money. That brings us to the end of this video. If you love similar content like this, take a look at my other videos, and if you like it, please smash the like button and make sure you subscribe to the channel and hit the notification bell. If you have further questions, feel free to comment down below. See you in the next video.